Chipotle's been tanking since its earnings miss in July, but is it finally time to buy the dip? In the next few minutes, Nick is going to break down exactly how he's playing the setup and how you can too. Let's bring him in. All right, welcome back, Nick. Our new burrito capitalist is here to give us his trade idea. So listen, you came up with a great idea on that Duolingo many weeks back. It's been working out so far, so I brought you back on here so we can talk another trade idea. And so you message me and say, listen, you're looking at Chipotle. I'm like, this thing's been going down. I needed to find out what's on your mind. So why don't you give us the pitch? What are you looking at? What are you thinking?
Well, right now with Chipotle, it's been falling all year essentially. The stock is
Yeah. Here, I'll
beat
pull
to
up the
crap.
chart.
Yeah, it's beat to crap, and it's trading at multi-year lows right now. Um, Basically, I see it as a pure asymmetry of risk play right now. The cautionary aspect of the trade would be that the consumer is slowing right now. So when consumer spending slows and consumer confidence slows as unemployment rises, the consumer has less money to spend on discretionary purchases, and this include eating out essentially, right?
Yeah.
So Chipotle would be one of the things that they might cut from their expenditures, perhaps. But that being said, I like the value of the company right here, and I wouldn't mind owning it at a cheaper price. But I do think there's room for a bounce into the end of the year. Now, would I enter this trade right now? Probably not. I'd wait maybe a few more weeks because seasonality still is in effect, and I think that this year we're going to see a shift toward October OPEX roughly, where we bottom out in the market in the short term. So it's possible we see Chipotle go from 39 and change right now to 37 or 36, perhaps even.
Right.
So the overall,
So let's look at the technicals. Overall, first of all, Chipotle. Let's stop and even put into context that during the last 5 years, Chipotle has been one of the hottest stocks on the market.
yeah,
This thing ripped from 2018 lows like $5 all the way up to like $70 a share. Just a beautiful trend. We put in a topping formation, a double top retest back last year. And generally, the stock has been distributive in nature. But we are getting, after an earnings miss back in July, we're getting pretty oversold on this position technically. So, after the stock is more or less approaching being halved in the last 2 months, the question, of course, is it getting cheap enough? So, how are you playing it?
so I'm looking at the January option expiration for 2026. So about 4 months away, roughly. And I'm looking at the 40-50 call spreads right now, which currently overall, if you were to build it out as it stands right now, you're getting it for about roughly $2.50 or so. So you're risking 250 to make a maximum profit of 750. So your asymmetry of risk is essentially 3 units of reward per unit of risk. But if you pair that with the cash secured put at the 35 strike, you're getting that put sold for around $1.50 or so. So your debit then would go from 250 down to $1 essentially. So risking $1 to make $9, or you own Chipotle stock at 36 because the cash secured put strike price of 35 plus $1 overall debit, so 36 in that, which is about roughly 10% lower than the current price of the stock right now.
So let me just see if I can clarify exactly what you're looking at. So what you're doing is you're opening a bull call spread out to the end of the year, betting on a bounce in Chipotle, and you're talking about $2.50 to $3 costs for this $10 wide spread to the upside, but you turned around and you're saying, well, I want to finance this cost. I don't want to just outlay all this money. So you're looking at selling cash secured put options down at the $35 strike, which are paying about $1.50. And so you're substantially reducing the overall costs. Now, what's the trade-off? The trade-off here is that you're securing at the bottom that you're willing to buy these shares at $35. So if they get down there lower, You've said, I'm going to be a burrito boy capitalist here, and betting that they're going to raise the prices of guacamole sides to bring up their profits. But you're basically saying that you're in there. That's where you're willing to actually be an investor. And
Correct.
otherwise, if the stock turns around here, then you've got the spread to profit from this move.
That's correct. Yeah, and I actually do like it longer term. It's just a matter of I'm thinking about it in the shorter term, in the context of the economy is slowing. We're seeing obviously job losses right now, no job creation really. And that's a function of perhaps use of AI. I won't attribute it all to AI, but the tariffs could have some knock-on effects there as well. But in the longer term, buying Chipotle at 35 should be a pretty good deal, and I would expect in the next, roughly 5 years or so to see a double up or so in the stock price. And that would be like the longer term view. Again, this is a trade, a short term, 4 month
Yeah.
roughly trade where you're risking 1 to make 9 in my mind, because I don't think it'll get much below 35 anyway. And if it does, well in advance of the expiration date, you can always roll your position forward, or you can close out the cash secured put if we do pop to the upside, for example. There's many ways to skin this cat, so to speak, right?
Yeah. Well, the one thing I'll technically observe here, Nick, is that your idea where you might want to give it a few weeks to sort
Yeah.
itself out. I like that, because if you observe the way the stock bottomed back in April, I would equate the current drop to feeling a lot like
Hmm.
this move right over here, which is essentially that we're in a primary downtrend, making lower lows, and we haven't yet seen the stock establish a short-term fair value zone, a level where dips are getting bought, support levels start forming, and show that some sort of low is being banged out. So definitely, there's short-term vulnerability of a primary downtrend remaining in its trend, but you're giving yourself over a 10% cushion to the downside, giving yourself wiggle room to sort this all out. So it is interesting, a great idea for sure.
Yeah, and again, that's why I mentioned like I'm not currently in this trade yet. I do think that waiting till like middle of October might be the key, or might be a much better setup overall. And at that point, you might want to even shift to like February or March OPEX perhaps instead of January. You want to have enough time to see it through to fruition. Maybe catch a couple of earning reports, and see if it has some kind of pop to the upside on those catalysts, perhaps. And in the long run, I think that obviously I mentioned the long term thesis. Automation is taking hold in the fast food space, like Sweetgreen, for example, McDonald's. They're using AI plus robotics in the not right now, but they're going to be using robotics down the road, which will lower their overhead costs in the form of labor costs and increase efficiencies, and thereby increase margins. So longer term, I think there's value to be had. Again, short term, it's a crapshoot, but the asymmetry of risk here is nice. And if you were able to, for example, sell that 35 strike put for like 250 instead of $1.50, and then you buy
Right.
that 40-50 call spread for like, let's say, $1 instead of 250, then you have a net credit of $1.50 overall.
You're
Your cushion's
golden.
down to like 33.50, and then your asymmetry of risk is that much better.
Right, right. Love it. All right. Well, listen, Nick, where can people find you if they want to follow your stuff?
I have a YouTube channel similar to yours, Option Infinity, or actually, no, it's my name, Nick Galarnik, on YouTube. And then my website is optioninfinity.com as well.
All right. Awesome. Well, thanks, Nick. Have a good one, buddy.
Thanks, Patty. Take care.